Hello everyone. In the next 3 minutes, let's break down the Sharpe ratio, a measure of an investment's risk-adjusted performance. It doesn't just look at how much you earn, but also how much risk you take to earn it. What is the Sharpe ratio? Simply put, it is the excess return divided by volatility. For example, if you deposit $10,000 in a bank and earn $300 in a year, that represents the risk-free rate of return. Any return above that $300 is considered excess return. Now, suppose a fund earns $1,500 with a volatility of 20%. The additional $1,200 earned above the risk-free return divided by the 20% volatility gives you the Sharpe ratio. The Sharpe ratio tells you how much return you receive for each unit of risk taken. The higher the number, the better the risk-return trade-off. Let's look at an example. Investor A and Investor B each invest $10,000. Investor A's fund gains 15% in a year with a volatility of 20%. His Sharpe ratio is 15% minus 3% all over 20% equals 0.6. Investor B's fund gains only 8%, but his volatility is just 5%. His Sharpe ratio is 8% minus 3% all over 5% equals 1.0. At first glance, Investor A earned 7% more. However, he also took on much greater market volatility. During unfavorable market conditions, a loss of 20% in a year would still fall within the fund's expected fluctuation range. Investor B's investment, with only 5% volatility, faces far more limited downside risk. This highlights the value of the Sharpe ratio. A higher Sharpe ratio means better returns achieved with less volatility, resulting in greater investment efficiency. Generally speaking, a Sharpe ratio greater than 1, the return is reasonably compensated for the level of risk taken. Greater than 2, the balance between risk and return is considered excellent. Less than 1, high volatility is not adequately compensated by returns, indicating lower efficiency. Negative, the investment underperforms even a bank deposit, resulting in a loss after adjusting for risk. To sum up, when comparing investment products, don't focus solely on returns. Take a look at the Sharpe ratio as well. It helps reveal the level of downside risk behind those returns. Remember, successful investing isn't about who earns the most. It's about who achieves greater returns with less risk. The Sharpe ratio is one of the key tools used to measure exactly that.